recording, we're good to go.
Will do.
Okay. All right, I'll call the meeting of the Montana Board of Investments, regular board meeting.
So,
October
Okay.
11th. Sorry, Mark.
He's on mute now.
Oh, okay. So I'll call the meeting to order. And so, just so everybody knows, of course, we're recording the meeting, as you've been told. And Savannah, could you do a roll call for us?
Absolutely, happy to. Good afternoon, Mr. Chair and members of the board. Jack Prothrow,
Here.
Cindy Youngkin,
Here.
Porter Bennett,
He will be tuning in later.
perfect. Tim Kober,
here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Dan Trost,
Here.
Dwayne Iverson,
Here.
and Senator Jeremy Travis. I don't see him on. He might join later, though. However, we have a quorum. Thank you, Mr. Chair.
Okay, thanks, Savannah. So we're ready to proceed with business. First part is I'll call for public comment on issues within the board's jurisdiction. Any public comment? Hearing or seeing none, we'll move on. The first order of business is the approval of the minutes of the last board meeting, August 23rd. It's in your board packet. Is there a motion to approve the minutes?
So move. Second.
Moved in second. Any additional corrections or comments? If not, we'll call for a vote. All those in favor of approval of the minutes, say aye.
Aye.
Anybody against approval of the minutes, same sign. Hearing none, they're approved unanimously. The next step is administrative business. Mark, if you're ready for audit committee report.
I am ready. Thank you, Mr. Chairman. Whoa. Okay, so the audit committee met. Member Porter was, or Member Bennett was absent for our meeting. Otherwise, it was a full committee. There wasn't any executive director report. And then we went through the SOC 1 Type 2 audit with Whipley, Jackie Cooper and Torby, I don't know the gentleman's name.
White.
Okay, and presented their findings of the draft report for the committee. There were no findings. There was no management representative letters or anything like that. We had a discussion about various risks and documentation of processes and procedures ahead of any turnover of staff and risk of using other service organizations and their controls for them. However, Whipley assured us that the board's processes to review other service organizations, entities, and that sort of thing were sufficient. The committee voted to approve the SOC audit to present to the full board for full board approval. We also went through the audit checklist that we received from staff. The board is in the process of having of the LAD, Legislative Audit Division audit of the fiscal year 23 financials. They started in August and came back in October to complete, and they're completing their field work by the end of October, I believe, or they will be back in the next week or two to complete their field work. However, the board has completed draft financial statements of the Unified Investment Program and the Enterprise Program, and have submitted them per state, I guess, state law, to the Department of Administration. They've also provided it to other entities to help them complete their financial statements. And they've also posted the draft financial report for the STIP account online for entities that are customers of STIP to use those numbers for their own financials as well, with the understanding that if there are any findings by LAD with corrections to those financials, that those entities would be informed of those changes, and they would have to change their own financial statements. They also, the board is also working on the annual annual report of the board that the board, full board, will be able to review at the December meeting. So with that, Mr. Chair, our committee would recommend approval of the SOC 1 Type 2 audit completed by Whipley for the fiscal year 23 period for the full board approval.
Okay, thank you, Mark. So with that, that's the motion. I think we need a second.
I'll second that, Mr. Chairman.
Seconded. Any discussion or questions? If not, all in favor of approval of the SOC 1 Type 2 audit, please say aye.
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 Any opposed, same sign. Hearing none, the audit is approved. Anything else, Mark?
Nope, that is it, Mr. Chairman.
Thank you. Jeff, Loan Committee.
You bet. The Loan Committee of the Board of Investments met this morning, similar to the Audit Committee. Member Bennett was the only member of the committee not present. The committee did have a quorum to conduct business. Executive Director Villa provided an update on activity within the new programs established by the Homes Act, specifically the Impact Fee Loan Program, which he noted had $9 million of a $15 million allocation reserved in a relatively short period of time since being established, and in the Linked Deposit Program, which had roughly $15 million of $25 million reserved. So both programs have seen a lot of popularity, which is positive to get those funds utilized for establishing new housing opportunities. We reviewed an intercap loan request for the Montana Fish, Wildlife, and Parks for $1.6 million to upgrade a helicopter. That motion was approved by the committee unanimously on the based on the recommendations of the intercap loan staff. And that concludes my notes.
Okay, any questions? If not, thank you, Jeff. Next is Human Resources, Maggie.
Okay, mine will be very brief. The only person missing was Porter Bennett again. All other board members were present. We basically limited our entire long meeting to the review and discussion, extensive discussion of exempt staff valuations as presented by CIO John Putnam and Executive Director Dan Villa. And I think that's probably anything I'm missing on that. I think we added a couple of goals to the Executive Director's goals for this coming year, and based on our conversations with these two individuals, I think we have an amazing staff here, and we're very fortunate. And they're doing some good succession planning and stuff, so it was good to hear from them.
Okay, any questions for Maggie on that from anybody? Again, the board was basically there, so we covered a lot. I'd just like to add for the minutes here that I'm very impressed with the staff and the job they're all doing, and I want to congratulate them and also acknowledge that the board, I think I'm speaking for everybody, that we appreciate their hard efforts and the good job they've done. Okay. Next,
Is this where we applaud, Mr. Chairman?
Feel free, Mark. Anyway, we'll go to pension board members, and Daniel, you have a report, I think.
I do, yeah. I met with the TRS board last week, and a pretty short meeting. We spent most of our time talking about the actuarial valuation report that just came out from Kavanaugh McDonald, our longtime contractor of actuaries, and looked pretty good. We decreased our amortization period from 25 to 24, which in a perfect world, that will go down at least 1 year every year. The funding ratio increased from 71.7 to 72.5, so funding ratio up, amortization period down. The only thing I'll add, so by and large, it was a great valuation, and there weren't any significant changes or issues. We'll have our experience study again here shortly, and we might make some minor adjustments there, but it looks like we're really on the right track. The only thing I'll add, I think we kind of discussed this briefly earlier, but there's 2 new disclosures that are required. The actuarial groups that work with not just public pensions, but all pensions nationally have added a couple of disclosures. One of them is the low default risk obligation measure. And I try to pin them down to what interest rate they use to equate to a low default risk. And it's something like treasury bond yields, but it's actually not a rate, it's a yield curve. And so at each level of the actuarial analysis, it's a different rate. So they kind of laid out a little bit about how that works. Obviously it's a lower number than what we're able to earn here. And I think what we look at that as is a way to talk about the benefits of having someone like the Board of Investments managing the money, able to return a lot more than the US Treasury rate of return. The other disclosure that has been added, you're required to now show what it would look like, what the contribution rate would have to be if it were a 20-year amortization closed at 20 years. And that rate for us would have been 13%, which is above what our actual contribution rate is. So those were the big ticket items there.
Okay. Any questions at all? If not, Maggie?
Okay, we met on the 5th, and for the first time in 20 years, all of our, how many are there? 9, 10 plans amortized under the 30-year period. Now, I have to point out that part of our ability to do that was the infusion of funds from House Bill 569 to HPORs, game wardens, sheriffs, and I think it might have been MPORs too. I just kind of off the top of my head, all the service entities. I have the amortization periods for each of those here. FERS has gone to 10 years, game wardens to 25, HPORs to 25, judges, of course, is at 0. MPORs would go to 21, PERS to 28, sheriffs to 25, and volunteer firemen to 1. I also want to point out in that same bill, there's language that indicates that if any of these 4 systems that got the infusions have an increased liability in their future valuations that are performed, it would be considered contemporary liabilities, and it would be amortized over a 10-year period. So you'd have your regular amortization period, and then you'd have this increase that's amortized over 10 years. And we also had the same requirements that Daniel talked about with regard to the new calculations done by the actuaries. And it's kind of interesting to listen to the actuaries. They just said, well, we're doing it because we have to. Not that we agree with it. So I think I also have the amounts of those unfunded liabilities if anybody's interested in that. So 5 plans.
Let's just end with the good news of we're in better shape than we've been in 22 years.
That's what I said. I'm happy. I'm smiling today. So.
Well, that is nice. So any other questions for Maggie? Hearing none. Senator Trebus, I don't think is with us. Just be sure.
Let's see.
So,
Nope.
okay, so we don't have a legislative report this time. And so I think that pretty much finishes tab 1. Anything else, Dan?
Not for tab 1, but I can move into tab 2 if you're
Okay,
ready.
we're ready for tab 2 and Dan's report.
So you have the new September snapshot on your desk. Do need a couple of votes from the board. We presented the 2024 board meeting calendar last meeting. Would like a motion to adopt that calendar, if the board so inclined.
Okay, we've had time to look at that. Not totally in stone, but that's for planning purposes. So is there a motion to approve the board meeting calendar?
So moved, Mr. Chairman.
Second. Moved and seconded. Any discussion or anything? If not, we'll call for a vote. All those in favor of the meeting calendar, say aye.
Aye.
All those opposed to it or want to change, say the same sign. Hearing none, the meeting calendar is approved.
All right, Mr. Chairman, same song, different verse on the biennial work plan. This outlines our agendas for the calendar year 2024 and 2025.
So the work plan is sort of a 2-year plan so that we cover all aspects of the board in depth in our various meetings. I think it's kind of a standard plan, not much change from last year. So is there a motion to approve the 24-25 work plan?
So moved.
Is there a second?
Second, Evers.
Second. Any discussion or questions? If not, I'll call for the vote. All those in favor of the 24-25 work plan, please say aye.
Aye.
Anybody opposed, same sign. The work plan is approved.
All right, you have the annual securities lending memo in there showing our performance. Kudos to John and operations for working with State Street. Significant increase in that revenue stream over the last several years. De minimis risk to the board in that process. So we're just making money on the money. And thanks to John. Any questions on sec lending? If not, 2 new items. I sent the materials out earlier. As I mentioned, the Department of Administration is revisiting space allocation within the state. They have approached us about purchasing the Walt Sullivan Building to remove that U.S. Department of Labor lien. As I look at it, this would be and could be a very lucrative opportunity. I outlined the conditions that I thought it would be a good strategic partnership for the board, and that is that we were able to secure a 20-year lease, that we were able to purchase it for the appraised price, that we're able to lease it for the terms that we've leased we get market conditions, market terms for the lease dollars per square foot, that we get a lease for the land, and that we really the fundamental of it is we are able to make sure that the yield exceeds the bond approval. So I guess I'm happy to answer any questions. We have run the numbers on a hypothetical lease. We're seeing about on this building, assuming we get similar rates to what we get for our other buildings in that area, about a 17.9 IRR over the 20-year period and a 13.6% yield.
What was that, 26%?
17.92 IRR
And,
on the 20 years and a yield of 13.6%.
okay.
So
appreciation value in there.
rent escalator of 3%, which is our standard. Expense inflation factor of 2.27, inflation appreciation of 3%, which is a little above what we've seen, and then a discount rate of 5%.
So you need a motion?
I need a motion to authorize me to proceed with the acquisition under those terms.
Can I ask a couple of questions, Mr. Chairman?
Certainly, Mark, I'm glad you are. Go ahead.
So, Dan, the purpose of doing this from the state's perspective is to get out from under a lien that the federal government has on the building?
That is step one. Step two is they want to consolidate agencies into one building. So in
Okay.
this instance, they want to have either all of Department of Revenue or all of Department of Labor or all of Department of something in one space as opposed to spread out across the city of Helena.
Okay, but they could do the reallocation if they still own the building. They don't have to sell it to us to do this reallocation,
Only
except for
if it-
this lien.
Correct, that's exactly correct.
Okay, but why don't they just pay off the lien and not worry about selling the building to us?
They don't have the appropriation authority or the legislative approval to do so. If they were to do it themselves, they would have to go get a long-range building appropriation.
Okay, I understand that. Then the question is, and I know we've talked about it, but well, why does the administration think that they have the authority to sell the building and not go through the processes that you mentioned?
So I've got a paper memo here, and Dan White, if you're watching, would you please email that memo you prepared to Tim and Porter and Mark? We've looked at it from both sides through that lens of A, do we have the authority to buy, and B, do they have the authority to sell? We believe they do. If for some reason their lawyer comes to a different determination, which I'd be a little upset about, that after they ask and we proceed with an appraisal, they find out they can't,
Possible.
we would obviously not proceed.
Okay. All right, well, okay, I haven't read it. I'd love to read it, but if you're saying that based on your evaluation that they do have the legal authority to sell it and we do have the legal authority to buy it, then I guess I don't have any issues with it.
And I guess the only thing I'd add is if we believe they have the ability, we believe we have the ability. If they come forward and say they don't, then obviously we won't proceed. So we've got another layer of stopgap in here.
Okay.
Okay. Any other questions? It's a bit unique. Yeah.
How come there's a federal lien in the first place?
They used federal grant dollars for ongoing maintenance and roof repairs, which then gives the feds the ability to have that. And until the feds are paid back for it stays on.
Has the state paid any of it?
Nope. Haven't need to because it's always just been Department of Labor. So it could, if Department of Labor stayed in there forever,
Yeah.
which now the plan is not to have Department of Labor stay in there, this transaction would never be necessary.
Okay.
So it
Okay,
doesn't
so
really
that's
pay
another.
the state, does it? I mean,
There would have, from a purely fiscal perspective, there's no incentive to do this. From an operational, team building, management perspective, it's the position of the state that this is the best path forward. Not our lane, but if we can get a 13.6% yield on it, he's not doing that.
why
Well,
not?
careful. Jeez.
So do you need any formal approval? Or?
I need a vote to authorize staff to proceed with the acquisition under the terms discussed.
So moved. Okay, second. Moved and seconded. Additional questions or comments? None, I'll call for the vote. All those in favor say aye.
Aye.
Any opposed, same sign. Hearing none, approved unanimously.
Last item before I turn it over to Mr. Ramasco. You have in front of you a memo to me from Peggy McKeown, the Deputy Director. I guess I'll say what every state agency says and then back it up with actual facts. We're unique and different. We are special.
Special.
Yeah. So over the course of the last several years, there's been many changes in how the state treats its 11,000 employees. A third of our staff are not subject to those regs. We are statutorily exempt. So John, all of the directors, Doug, our investment officer, and myself doesn't apply. For everyone else, the state HR policies apply. So we're now administering 2 pay structures within the organization. As they've done this, the market survey, because there are no other investment analysts anywhere else in state government, there are no other, and you can see the descriptions here below. No one else is running a $250 million bond portfolio except for us. No one else is running another $250 million loan portfolio except for us. And the markets are coming back what I would describe as a little screwy. Over the last 2 years, at some of the greatest wage inflation we've seen, at least in Jeff and my lifetime, we're not seeing markets decrease at 12%. We're not seeing substantial drops in what people should be paid for doing the same work they were doing several years ago. So there's, to me, those data points, as well as some of the other items that PEG outlines relative to Fair Labor Standards Act, just say that we've officially been numerically demonstrated to be different enough that we should put ourselves in the same category as the Montana State Fund, or 1/25th of our assets, the horse racing stewards, the university system, that our employees would all be off of the same market that we purchase from McLagan, so all investment staff, all of our accounting staff. You know, to put it in perspective, our accounting staff do $32 billion a year in transactions in STIP. No one else in state government even comes close to touching that number. So this is not, I guess what I have to start at is, this is not an ask for a raise for anybody. This is an ask for us as a board, you, to determine the compensation structure and the classification and our go-forward approach to HR. The PGP is a wonderful tool. It has worked well. This motion and this action proceeding through the process would ensure that it's around. Happy to answer any questions, but it's a little, we're getting into the 25 session already, and boy, is that a blast.
Didn't DEQ do that for engineers a few years ago? Because they
So-
couldn't hire any and stuff.
PEG wrote their pay plan, and PEG wrote our pay plan. So it's very much the same. It is not a time in the seat type pay matrix. It is, you are compensated based on your contribution, your knowledge, skills, and abilities. There's no automatic longevity increment in our structure. It's, we determine, based on the knowledge, skills, and abilities you are assessed to have and your contribution, you can move up to the next level, which is exactly
Basically,
what.
recognition of a specialized labor force,
Correct,
getting it to a market rate to keep it competitive so you don't lose people.
correct.
So I think, at least, from my point of view, this is a critical issue in keeping the great staff we have and us managing this board in a highly professional manner. And so I can't overemphasize enough to the powers that be, especially the Department of Administration, that we consider this as a board here a real critical issue. So based on that,
What do we do? Do we grant support for the administration going forward and put that request, or how do we proceed?
We would submit it through what's called the executive planning process that's run by the governor's budget office, as this is a piece of legislation we would like to pursue
With the board's authority?
with the the board is requesting this, yep.
well, to be the board, not the staff or whatever.
Yeah.
And so,
So moved.
so moved. Is there
I
a
would second that.
moved and seconded? Any additional other comments? If not, we'll call for formal vote. All those in favor of that motion, please say aye.
Aye.
Any opposed? Hearing none, The motion passes unanimously.
Thank you.
Also, Dan, I'd just like to note that as you proceed with this, if you deem it necessary or anything that the board can do to help you with this moving forward, don't hesitate to call.
Will do. Thank you. And that's all I have unless there's any other questions or concerns.
Just the thing we went over a little fast, I thought, was a security lending update. In a financial crisis, which we've seen at least one since I've been here, maybe more, there can be some things that go wrong. And so my question really is to you, John. I think this talked to me for a minute about the risk mitigation and how you really, Dan basically said very little risk. There's no such thing as no risk, but could you just talk how we're protected a little?
Sure. So when you think about, securities lending, we're lending securities that we already own in the portfolio to entities that, State Street has a relationship with already, i.e. other clients of theirs probably, whether that's another pension plan, a hedge fund, or whatever, doesn't really matter. So they're lending those securities out. In effect, in most instances, what those entities are choosing to do is to go short. So when we're talking about shorting a stock, they're borrowing that stock, they're going out and selling that in the market with the anticipation, they're betting that stock value is gonna fall, and they're gonna be able to buy it back at a lower value and make profit. Okay, that's sort of the broad nature of sec lending. So when we lend those securities, State Street is our custodian and manages our sec lending program for us because we specifically hired them to do that. So when they lend the security, they are indemnifying us that we will get that security back. So if they lend that security to some other entity and they aren't able to get it back from that entity, they will replace it at their cost. Okay, so the risk that we're taking on there is simply, I guess, that State Street doesn't exist anymore as an entity. So there would be a bankruptcy scenario there, I suppose, in the most extreme example, that State Street can't meet that indemnification hurdle. I would classify that as a very small risk, but to your point, Jack, not non-existent. And it has happened to us. So I'll give you an example. Speaking of financial crises, we had that happen with one security in the Lehman bankruptcy. We weren't able to get it back from an entity. It was a kind of off-the-run agency, as I recall, and we ultimately ended up just taking a similar security in kind. So we lost no value there. It was lent to Lehman at the time. So there's pretty good mechanics in the marketplace and under a lot of stress scenarios where those transactions and kind of bankruptcy scenarios and things like that are generally sort of first in line, I guess, if you will, in the bankruptcy courts and things. So pretty low risk. The other side of that is so sometimes they would the entity that's borrowing that security, they have to put up collateral. Sometimes they will put up other stocks or bonds or whatever it may be, oftentimes state treasuries or something like that. And State Street on a daily basis would value those securities. And so to the extent that the valuations have changed, that entity may have to top off their collateral if the value of that declined, let's say. So reasonably low risk there as well. And that's part of why State Street indemnifies us, because there is collateral associated with that loan. In the second instance, some people might put up cash as collateral. When they do that, so they would pay, if they give us just other securities, they would just basically pay a fee for borrowing that security from us. If they put up the cash, we would then take that cash and reinvest it. State Street would do that on our behalf. As Jack will remember, and I certainly remember when we were in the financial crisis in 08, 09, State Street had a few defaulted securities within that cash
portfolio. So basically, they're taking the cash, they're investing it in a portfolio similar to what we do with STIP. Right? They had some defaults in there, so the valuation of that pool went down, and so effectively you couldn't give somebody the full value of their cash back. You know, that if you liquidated that entire pool. Lots of you know, things went on, I guess, over that. We did ultimately recover like 99.9% of that. There was a small loss, but it took us about 10 years to sort of recover that and allow those assets to, they were kind of walled off and isolated, and they eventually mostly recovered. So one of the things we talked about in August was we've created a separate account. So in the past, we were in a commingled account. So when we got cash collateral, it was invested in a pool with all the other clients that State Street has that are investing cash collateral. And that was where we were at in the financial crisis. And part of the issue was you couldn't let everybody out of that pool at the same time, because you know, somebody who escaped early on is going to be advantaged versus somebody who was stuck in the pool with the poor assets. So we've gone to a separate account structure. The advantage of that is a couple things. We control that pool. So if that sort of a situation were to arise in the future, at least we have the option solely. We don't have to go talk to anybody else. We can decide what we want to do with any assets that may or may not be impaired. So that's an advantage, because you know, we don't have to deal with all the other entities that are fighting over the same pool. Secondarily, we were able to set the parameters around which, you know, what they can own in that pool. So if we aren't satisfied, hey, we've set parameters similar to what Kirsten would have in STIP. So probably a bit higher bar than what they would have in the commingled pool. In addition to that, we're monitoring that. So if we see something that we don't like, we can just go to them and say, we don't want you to buy, you know, this security or this name anymore. So we do have substantially more control. Does not eliminate the risk, obviously, but it's, you know, similar to STIP, fairly low risk. Things can happen, sure.
I just can remember sometimes we had a discussion of that.
We had many discussions about it, Jack.
But I think actually what we're doing prevents some of the problems that we did have. So Becky, would you agree that?
I'd agree. The indemnification that you've negotiated is terrific, and a lot of things happen to improve sec lending programs after the GFC, you know, after a significant event. So risk has been reined in, and this program becomes what it really intended, and that is additional assets with very low risk relative to other opportunities. So no, we very much support the program.
When you're under the, okay, we lend that security, then we aren't able to sell it either for that time frame we've lent it then, right?
So typically how it works is we can sell it, and State Street, one of the advantages, they're such a large custodian, they have, you know, that asset exists in a lot of other places, so they will just give us ours back and swap it out with somebody else. So we generally see no impact if we're trying to sell or something. Occasionally, there might be a slight hiccup there where we've got to go out and say, we need to recall that or something, and there's some settlement issue, but it doesn't prevent us from selling or doing what we want to do.
Okay. With that, Dan, I think we've got your report completed.
Yep.
So we'll move on to tab 3, investment policy statements. I know we've all been looking forward to this all meeting. So John, with that introduction, you better be good.
It seems unlikely, but Chairman, before you, we are proposing a new investment policy and 2 minor changes to some existing policies. New investment policy is for the newly created debt and liability free account. That account was created by the 2023 legislature through House Bill 251. The main purposes of the account is to call and pay off callable bonds issued by the state of Montana, to defease the non-callable state bonds, and to pay in whole or in part legally resolved non-pension liabilities of the state of Montana. The funding from the account will come from the treasurer's cash account earnings. The legislature made that retroactive back to the beginning of last fiscal year. So the account currently has about $147 million in STIP in it. Additional funds will come from earnings from the treasurer's account, the treasurer's cash account through June 30th of 25. Earnings will be retained in the account. Any unobligated funds existing on June 30th of 2027 will be returned. We envision a large allocation to STIP to maintain liquidity for the bond calls. We also expect a significant allocation to individual securities. We think with maturities matching the interest and principal payments of the remaining non-callable bonds, we want to defease those bonds. We expect to use collateralized demand deposits in Montana banks and credit unions to match fund interest advantaged loans for housing development. We believe additional investments will occur to fund the reduction of as yet unknown liabilities and maturities, but those investments are expected to be among the allowed investments in the permitted investment section. Happy to take any questions. Seeing none, I would just mention that we're asking for a change to policy 4950, the homes account to add credit unions to the banks for fully collateral demand deposits. And then just note that if you approve the debt and liability free account, then we'll have to add that account to the controlling document 4090 for separate accounts.
Okay. So I think we'll probably do two motions just to make it clear. So is there a motion to approve the new proposed debt and liability free account policy? So moved. Is there a second?
Second.
Okay. Moved and seconded. Any questions or comments? If not, I'll call for a vote. All those in favor of the new proposed account statement, say aye.
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 Anybody opposed to that same sign? Hearing none, that's approved unanimously. And then we'll just have a motion, if you give me one, to update the separate management accounts investment policy statement. So is there a motion for that?
So moved.
Moved. Is there a second?
I'd second that.
Second. Any questions or comments? If not, call for a vote. All those in favor say aye. Aye.
Aye.
Any opposed, same sign. Hearing none, that's approved unanimously. Anything else, John?
Did we have 40.95 as part of the first motion? That was just to add.
That's what I was gonna ask. So the way I heard the motions was the 40952 and 40950 were approved in the first motion,
Correct.
and 40990
0.
was approved in the second motion.
Thank you.
Good question. That clarifies the
Yep.
minutes. Keep John out of trouble.
Thank you.
Which one?
We want to keep all out of trouble. So I think we can move to tab 4, asset allocation. And so here you go, John.
I know you weren't looking forward to this as much as the policy statement one, but.
No, I look forward to John, the other John.
All right, so asset allocation, as you said, tab 4, starting on slide 2 here, some of the key considerations to think about. Obviously, we've discussed asset allocation with some of you many times before, and it's critical to the long-term success of the portfolios that we manage. And the annual approval of the asset allocation is an essential task of the board. Reason being is that the weights of the asset classes, or how much that we invest in each of the asset classes, determines the majority of our return that we're going to realize. And it also determines the amount of risk we're willing to accept in pursuit of our goals. So there is no asset allocation that's right for every plan, whatever right means, but it's dependent upon the recommended funding objectives, the characteristics of the plan or the account, the constraints around that, whether that's risk tolerance or liquidity, legal or regulatory requirements, and also the opportunity set of investments that those portfolios would be faced with. And finally, we have to keep in mind that actual results measured over shorter time frames, I would say, necessarily will deviate from our long-term assumptions. We're never going to get that exactly right, but it doesn't mean that our assumptions are completely wrong either. And as we were talking about a little bit earlier, I think we need to keep in mind at BOI that for the vast majority of the investments that we manage, our horizon is essentially infinite, which is an important distinction between some other entities that may be trying to create an asset allocation. So how do we approach asset allocation or the asset allocation process? Turning to slide 3, we need to determine if there's any changes that have been made in client objectives and constraints. Of course, we're looking at the long-term shifts in the global economic environment. We're looking at the capital market assumptions that both RBK puts together for us on an annual basis, as well as many others that are out there in the market. And we're also looking at, a variety of economic information that we see on a daily basis out there. And oftentimes it's difficult to separate sort of the short-term noise from the long-term trend, but that is ultimately the goal kind of asset allocation, is we're trying to think in a more long-term context than just what's happening day to day. So we gather up all the senior staff, all the directors, myself, the executive director, all submit kind of their proposed asset allocation from their perspective, what they're seeing in their respective sectors. I like to get a variety of opinions and perspectives from everybody, because we all kind of live in our own bubbles, whether we understand that or not. That bias that we all have exists. And I look for, sort of similarities and big differences between what everybody is suggesting, and that's probably the area to focus on. Gather that up, provide some information to RBK about sort of how we're all thinking about things, give them a couple of scenarios that may have come to light in that process internally. And then they take that, run it through the mean variance optimization model for us, which is a mathematical model process of sort of evaluating what's the best asset allocation, given various degrees of risk, creating that efficient frontier, if you will. And so that's the best tool that we have really in the investment industry to try to create an asset allocation, but there are some significant limitations to that tool. So it's very sensitive to changes in expected return and the correlation among asset classes. It's backwards looking, so we're always looking back at what has happened to try to sort of project what's going on in the future. You need to apply constraints to that tool, because if you don't apply any constraints to the MVO model, you will generally get something that says, hey, you should be invested 80% in private equity and 20% in treasury bonds or something, which Thomas and Ian may think is great, but it's probably not a very realistic portfolio at the end of the day. The model assumes that it is a perfectly efficient market and that all participants are rational. I would certainly argue over my tenure that the market is not always rational, and certainly all participants are not.
I was gonna say, I'd argue over your tenure, all market participants are not rational.
No.
Specifically your tenure.
Right, it was me. And it tends to underestimate large negative events in the market, which happen significantly more frequently than sort of theory would suggest. So we need to guide that decision making. apply some qualitative judgment to the model. I think typically, you know, MVO tends to give us directionally what might be good ideas or some, you know, directional changes that we might make, but it doesn't ever give you, you know, the answer specifically. So then we go to Portland, or have in the past several years anyways, meet with RVK in person, offsite, take all the directors, the executive director and myself. It's always been a great conversation and a great time to sort of have a little more time than here in the board meeting to really discuss some of those issues in more depth, get everybody's, you know, thoughts on the table, about asset allocation, but usually about a broader range of things as well. You know, Becky, Jim, and Paige are there, of course, but we also get to tap into a lot of the rest of their staff that we don't, you know, have direct contact with, maybe on Zoom calls or over the phone or something. But it's nice to kind of be there and be able to do all of that in person for the day. And I think generally leads to a really good process. So questions about any of that before I
Just, I don't want to ruin anything for Boise or whatever, but Becky, more process than actual going through this, but do you like how we do this?
I do. You know, it's not a lot of clients that actually invest so much staff time to come on site and meet with us directly and hash this out over the course of a day. A lot of times we're just running multiple scenarios as different staff members at other clients say, hey, what about this? What about that? The way that your staff has been approaching this is to have a lot of those thoughts and ideas before we actually get together so we can actually collectively analyze them. So instead of sending 20 versions of an asset allocation back and forth till you arrive upon one that makes sense, we can actually thoughtfully look at the possibilities and have a good conversation. So we really like the time that staff has invested in this process, and we're delighted to host and add our own staff to that process. We think it brings a much more well-rounded evaluation of what makes sense. And there are going to be some years where you may see more directional changes, others less, but that doesn't mean that the process was any less effective. Sometimes when you go through this process, and this is the case this year, you end up re-underwriting the structure that you have largely because you feel that you're positioned well going forward. So we're very positive on the process, and we would be very willing, and in fact, I guarantee you, if we felt that there was something that you needed to change either from a process perspective or a direction in asset allocation, we would tell you that.
Because that's good to hear, because this is one of the few things that the board, full board, reserves the right to formally look at each year. So,
absolutely.
I just make a note, I think Dan had told me that Porter is able to join us, so thank you. Thank you, Porter, for coming finally.
Yep, sorry to be late, but it is what it is.
Yep.
Okay. All right, John.
One question there, you know, where we got all our top people going to a meeting, do we go in the same plane, same cars?
No,
We don't.
Good.
because traveling with him is a curse. He never makes a connection. There's always a delay.
Okay, good. I mean, because that's a concern. Sometimes you
Sure.
forget that that's one of your highest risks.
Yeah, key person risk.
Really.
It's true, I always do get delayed. I don't know why.
Do you make him drive or something?
No, so usually how it works is, and next year we're gonna make a little tweak, because we want, if we're gonna all be together, I mean, this is not a cheap meeting. We wanna turn it into not only a meeting with RVK, but a meeting amongst ourselves with all of the directors and have some more broad conversations. So next year, we're gonna have everybody fly out night before, go to the full meeting with RVK, spend the evening together, and then fly out the subsequent day. Better use of time as opposed to people flying in the morning, doing a 4-hour meeting and flying out later that night. Give us some time to visit with Becky's staff on their individual asset classes, any conversations we have to have as a team. Because we probably put in, I'd say probably 40 hours before we even go to RBK, just on site, walking through the scenarios, making our pitches to John, making our pitches to each other.
Does John have to fly out a day early then, so that with his delays, he'll get there in time?
We'll have to see, I guess, this fly by myself, nobody wants to go with me.
Not in a private plane, John.
Okay,
Oh.
yeah, all right, fine.
Okay.
Anything else? All right. All right, moving to slide 4. So obviously, there's lots of factors when we start to consider asset allocation, but I did want to kind of highlight net cash need here for the pensions in particular. We've talked about it a bit in the past, I think, but it's something that we keep a close eye on. So if you look at the two charts here, or tables, PERS and TRS, obviously the two large ones that essentially drive the majority of our cash flows. In recent years, the cash needed to pay benefits in effect each year kind of range between 3.5% to 4% of assets under management, let's say. And so that's a pretty manageable number, I would say, for us, has not been an issue in any way. Would expect that there would be some slight growth in that number over the next few years as we sort of see the baby boomer generation peak in terms of retirements, and then we sort of demographically start to kind of slide down the other side of that hill. I didn't have numbers for 2023 when I did this. We had some estimates. I would say, broadly speaking, they're going to be in that same kind of 3.5% to 4% range. So I think it's a very manageable number, as I said, but there are a lot of variables when we think about that. So those numbers are dependent on sort of the plan structure remaining somewhat as it is today. So changes to that could be a big variable. We're making some assumptions about growth in hiring. We're making assumptions about inflation and mortality tables and how many people retire and when and all those sorts of things. So it's in flux. I look at it each year, kind of make sure that that number isn't getting to a point where we would have to make some kind of a structural change in our asset allocation in order to handle that. I do not think we're there. In fact, in about 4 or 5 years, we think that this number starts to get better because you roll over with the baby boomers, there's fewer retirements for a period of time. The people who have the higher GABA start to roll out of the system. That is a big impact, and we've had some changes to the pensions over the years that have sort of shortened things up. So questions about the net cash need for the pensions currently? All right. So moving on to slide 5, I thought that I would give a little bit of history, give some context, particularly for some of the newer members to understand sort of what we've done over the last 5 years or so, which can maybe hopefully gives you a little bit better color for maybe why we made the decision I made this year. So if we're looking at slide 5 here, on the right-hand side, that was the asset allocation in 2018 under the prior CIO. Okay, would have been approved in late 2018. And in 2019, you can see we made 4 relatively major changes here. So first one, the fixed income asset class, we rolled that back together. So as you can see on the right, it had been disaggregated into kind of the subsectors of the fixed income portfolio. And those were all individual portfolios or asset classes. We rolled that all back together as it had been previously under the Barclays Aggregate Index, which would somewhat be, I would say, kind of the industry standard way of managing your fixed income portfolio. Second, high yield, we turned that into non-core fixed income. We added EMD, preferreds, and converts. You've seen us come to you repeatedly over the last few years here and add those various strategies as we've gone along. Third, diversifying strategies was an asset class, which at the time, there wasn't a lot in it. It wasn't real well defined. It had things like GTAA, which is a global tactical asset allocation. You're hiring a manager to do an asset allocation, something that probably looked very different than what we were doing. That was kind of the only thing that was in there at the time, but we were discussing things like currency strategies, hedge funds had been kicked around a little bit. So long story short, we decided we didn't want to do any of those things, and we eliminated that particular asset class. It was sort of the catch-all bucket. And then finally, cash. Cash, previously we had a range, but that range only applied to cap. So the cap portion of the pension. So that was a 0 to 5% range, but it did not include the cash that was at the pension level. So TRS, PERS, and all the pensions, they hold cash outside of cap in order to pay benefits. And then there was cash at each of the asset class levels within those funds, significant amounts of cash in some instances. So you rolled that all together and we had, upwards of 10% cash in the overall portfolio at the time. That was not transparent to the board and was probably not a place that we wanted to be. So we changed that so that the cash range applies to the entire pension fund, regardless of where cash sits in the portfolio. And then we adopted midpoints, official midpoints for each of the asset classes. Just to add, transparency to staff decision-making, we enhanced the reporting. So what you see Aaron come to you each quarter and give you the attribution analysis. I know it doesn't change very much, and maybe we don't pay a ton of attention to it a lot of times, but if we were to make large asset allocation changes, you would see it in that attribution analysis that Aaron's giving us. And so that was an effort to, again, bring some more transparency to the reporting to the board. Questions about anything there before I?
Yeah, I was just curious if you could hear, can you hear me?
Yes.
Okay, the natural resources range in 18 disappeared, or is it assumed into one of the other groups?
So natural resources went into real assets.
Into real assets, okay.
Yeah. And so we actually, it's a good point, Porter. So we had natural resources, but we sort of expanded into what a real asset. So the language that we would think of now would be, we have natural resource or commodity type strategies within real assets, but we also have infrastructure, which was something that we weren't really doing a lot with at that point in time. We did have a little bit of it, but so real assets became, commodities, natural resources, however you want to frame it, and infrastructure, and then tips as well into that portion of the portfolio.
Okay.
So moving to slide 6, you can just see the subsequent years here where, I won't go through all this, but high level, I would say, over that time frame, we've reduced public equities a couple of percentage points. Effectively, that flowed into kind of non-core fixed income that went up a couple of percentage points. The biggest move here was probably the reduction in core fixed income, significant reduction in 2019. Obviously, we had interest rates that were very close to zero at that point in time. So looking for better places to get some yield and better returns. And a lot of that went into the private asset classes. So private investments, a couple percentage points up, real estate and real assets also a little bit up. And, high level, I think over the last few years, the story had been, low interest rates. Well, let's, find better places to deploy capital there. Good returns in the illiquid asset classes. If you look at our long-term returns, we have exceeded public equities there. So we've been able to capture some of that illiquidity premium. Real assets, expanded that a bit, and that was both diversification and good returns and good cash flows there. And then sort of higher valuations in general in public equities, as well as kind of the ongoing struggles maybe in the international equity portfolio. So questions about the history, at least, of the asset allocation over the last 5?
We also did that liquidity analysis, I think in 19, was it?
Yeah, that sounds about right. We looked at how much we could take on in the sort of illiquid asset classes, and found that we had, I don't recall the exact numbers, but it was significantly more room than even what we've done to date. Okay, so moving to slide 7, asset allocation history for trust fund and state fund. I didn't list out all the years here because, you know, it doesn't change quite as frequently, but for trust fund, John Ramasco has talked about many times, we did increase the real estate range in February of 2020 quite significantly, and then we added real assets as well more recently in May of 2022. State fund, we added our non-core fixed income in February 2020. We've been working on that for a long time at that point. And then more recently, of course, in just this year in April, added real assets and made the change to the full aggregate benchmark rather than the intermediate ag. And you know, I just would say that some of those changes that we've made in trust fund and state fund, you know, we're still working on implementing some of those changes. Obviously, these portfolios are more limited in what they can invest in given their goals, constraints. But broadly speaking, it's been an effort in these two portfolios to diversify the assets that they hold and still be able to achieve their goals, which is generally a little bit more income driven than perhaps what the pension fund is. Questions on any of those changes? Okay, so slide 8, not proposing any changes to the current asset allocation for CAP, trust fund, or state fund this year. You know, I would note to kind of tag on to some of Becky's comments, and correct me if I'm wrong, Becky, but you know, I think we probably do asset allocation or have this discussion more frequently than many of our peers. So a lot of our peers would probably be more like every 3 years or maybe even every 5 that they would sort of do that type of deep dive. So, you know, maybe that's one reason, I guess, why feeling comfortable that we don't necessarily need to make a change. But in addition to that, you know, there's been no changes to our client objectives or constraints. We did, as Maggie was noting, we got some more funding for the public safety plans, but in the scheme of things, that really just brought them more in line from a funding perspective to the rest of the pension plans. So I don't think that there's any need to do something different there than what we would do for the rest of the plans. The mean variance optimization process that RVK did for us this year, you know, suggested relatively minimal changes in terms of the we might move asset class weights. Certainly, those were well within the current ranges, and so I think anything that we decided to implement at this point and have, frankly, we can do within the current ranges that we have. We can implement those types of tactical views. And as I mentioned, trust fund, state fund, we're still kind of implementing some of those things. So similarly, wouldn't want to necessarily take on something new there at this point in time. You know, I guess I think of some of this as, you know, just because we can do something in the portfolio doesn't necessarily mean that we should or need to. I was teasing, I guess, let's say fixed income, you know, one of their mantras is, you know, doing nothing is oftentimes the best answer, and they're the absolute best at it. So, you know, maybe we're stealing a page out of their playbook, I guess, if you will. But I do think that, you know, oftentimes I think investors feel pressure to do something to prove their value one way or another, and oftentimes, you know, that's sort of the wrong answer, and you should really be asking yourself, you know, is there actually value to making a change, and it's going to move the needle in any way, shape, or form.
Oh, man.
Pull ourselves up. There's fixed income, see, right on cue. So with that, I guess I'll take questions on.
Hey, John, I just have a quick question. The midpoints are approved.
Yes.
They look to just be mathematical.
They are.
So if we want to move the midpoint, that means we have to move the range? Is that how that works?
Yeah, we sort of purposely did that because if you look back at the 2018 one, the midpoint adds up to like 105% or something like that. And, you know, it sort of, I think, in some ways obscures perhaps what we're doing as staff if we're not, to me, it's a little more intellectually honest, I guess, to say, well, here's the range and the midpoint does add up to 100%. And, you know, if you just are moving the midpoint around, and in fact, you know, point of fact, we didn't even have a midpoint, we just had a range. And so you could just, you know, move within those ranges. But, you know, it I guess to me signals if I'm coming, you know, during the quarterly meetings and saying, well, we're below the midpoint or above the midpoint, well, that necessarily comes at the expense of some other asset class somewhere. And so you have to see that, I guess, in the end. And so that's sort of why we picked, or, you know, made the process that way more explicit.
Yeah, I could see it, if it was called a target, then you could be anywhere in the range. And you might have a discussion if you're outside the target, but you, outside the range, you'd always have a discussion. If you're off the target, there might be a discussion, but it might give you a little bit more leeway to not have the discussion every time if you just move the target and say, this is why we're gonna move our target, but our range hasn't changed.
Yeah. I guess in effect, you know, I always hesitate to kind of call it the target because things change so often and so fluidly. But when we look at attribution, that is in effect how attribution works, right? So Aaron's looking at, you know, what is the midpoint and then saying, well, what's the effect of our positioning away from that midpoint? Now, as we talked about, that may be purposeful or not, depending on if it's just a denominator effect and our private investments went up because our public investments went down or something. So it's not 100% within our control, but at least, you know, we can talk about it and think about it at least in those terms, yeah.
And we purposely avoided the target for that reason, is we didn't want to be discussing, you know, why are we off by this percentage or that at each quarterly meeting? Because it was a new concept for the board and for staff. We weren't sure how macro attribution reporting was going to actually roll out for those first few years. And at least in our experience over the last 5, it's been productive to know that we're coming to you within the ranges, and Aaron is explaining, here's why we're over in public equities, here's why we're under in international. Avoiding targets, I guess where at that point the cabinet and I landed was targets is a lot more work up front and a lot more day-to-day frictional balancing than midpoints within the range. And if we start getting to targets, do we have to balance to those targets and how frequently in order to keep the board happy? So that's why we stayed with mathematical midpoints that add up to 100 and ranges that give us some flexibility.
So I guess this way, if it is purposeful, we'll just move the range.
Yeah,
Okay.
around it.
Yeah.
And a lot of plans do have targets, but it also, if your policy requires them to rebalance to target, there's a lot more transaction costs that they're generating to constantly get back to that point. We've actually got a rebalancing study that we refresh every couple of years that has found that if you do have a target philosophy, in a lot of cases, the best thing to do is just keep inside the range and make sure you are inside the range, but not necessarily go back to target if you had one. So we think it effectively gives you the flexibility that you need. And you know, every day you get back to target, if you have one, the market's going to move you away from it almost immediately. So this is kind of balancing the best of both worlds, but it is a little nuanced compared to other plans that have just always thought in terms of targets.
Pretty hard to set a target for a year.
Yeah.
There's too many variables, you know, the
There are
ranges
tons.
give you an ability to manage,
Right.
and that's what you have to do in the market to make your money.
I kind of think about it, if you think of the pension plans, especially as an aircraft carrier, you're constantly looking forward using your instruments to make sure that you're in the lane of where you need to be to get to your end destination. And there could be various influences along the way, wind or whatever it may be, that may cause you to adjust that course, or you may decide consciously to go to another destination. But you're choosing to be in a lane and make course corrections as you need to. And And most plans don't need to change their destination every year.
You know, if I could interject here for a moment, the word target, so oftentimes the words you use affect the way you think about it. When you think about asset allocation and you use the word target, all of a sudden you've collapsed and you've looked at a specific number for a specific asset class. But asset allocation is not that. It is actually the points of allocation for each of the asset classes in a set that creates a portfolio that the fiduciaries are comfortable with, predominantly because of its risk return characteristics. And as John said, some years ago, you moved to this process, but also it allowed you to, in essence, it allowed the board to see the consequences of being away from that set. It's not just a target, it's a set of points that add up to a specific asset allocation. And I agree with Dan. I think it's been productive and it's been helpful, and it's something that we recommended some time ago. And I think it's been additive to the understanding of the behavior of the portfolio without inhibiting the staff's and John's ability to actually manage cash flows and deal with market changes that, as Becky said, can drive you away from or toward any particular point for any particular asset class in that set of points that makes up your asset allocation. So I'll stop there.
Anything else, John?
No, Mr. Chairman, I won't read you the summary page points. I think you got it, so.
Okay. This, since you traveled this all this far, Becky, knowing that we're going to revisit this, is there anything else you'd like to add on this topic?
Maybe just the fact that when we were looking at various possible small proposed targets, we did look at some other tools that John had mentioned, which are shortcomings in this kind of modeling, which it assumes that the world is perfectly distributed around the median return for an asset class. We actually applied some other tools outside of that look at worst case markets and assume that fat left tail, as we like to call it in the equity markets, or in statistical speak, non-normal distributions. And we came to the same conclusions that John had mentioned, that there really wasn't anything substantive that would cause us to move away from the midpoints and ranges that were already in place. So those were good conversations, because obviously we're in an uncertain world, markets are volatile, and we are much more realistic that the world is not normally distributed in terms of how investments are experienced. So I'll just add that little note.
Okay, thank you. So, as I always like to be a little ahead of schedule, but I think we need a little break here just to stay awake. So let's take a 10-minute break just to get some coffee or whatever, and then we'll start again.
Say hi.
So we'll see if you're napping back here now. If you're gonna take a nap, we'll know.
This really aggravates me.
I don't know, I think you need an adjustable podium.
So anyway,
Oh, yeah, adjust the camera down.
we're on tab 5. And Thomas and Ian are here, and so we'll look forward to their presentation.
Thank you, Mr. Chairman, members of the board. Thomas Winkler, Director of Private Investments. I'm here with my senior analyst, Ian Holwood. Since we're a team, we decided to split up the presentation, so we're going to be bouncing back and forth a little bit. Hopefully it's not too disturbing. We tried it yesterday and it seemed to work pretty well. And additionally, we're trying to keep it a little bit dynamic, conversational, so please interrupt. Stop me if I'm going too fast, too slow. If you heard something before, just tell me to skip it, and we'll just kick it off. I'm going to kick it off on slide 3, just to give you a little bit of an overview of the general portfolio of the pool, and then Ian will take over a little bit later and give you a more deep dive on the actual portfolio construction and what we have in there today. Later we'll hit a little bit on implementation, what we've got going on, why we do what we do, what kind of constraints we're looking at, and then Ian will close it out with a pretty detailed review of our investment process. we thought that might be useful to, especially some of the newer board members, just to get you really comfortable with what we do and how we do it and how much time and effort it actually takes. As I said, on page 3, I'll kick it off with some of the primary role allocation constraints that we have in the portfolio. And just heard John talk about asset allocation, so that is driving a big portion of this, what you see on the slide here. Primary goal for us is to build a diversified portfolio of private assets that is accretive to the overall pension return. We do that in a number of sub-asset classes, which I'll touch on the next slide. We do have a benchmark provided by RBK, which is a split benchmark of equity and debt. There's no set targets. It's floating with the current allocation as those change throughout the year. And just keep in mind that we're not managing to that set benchmark. It's really just a performance tracker, if you will, over long periods of time. See if we are actually, in fact, outperforming the public markets, which is one of our big goals. I'm not going to talk about the allocation ranges. We just went through the asset allocation. Nothing has changed there. We are in our range a little bit above the midpoint. Not a concern there as we review that on a regular basis with John, our Director of Risk Operations. So all of these things are monitored. And same thing with the other policy constraints. You see little check marks there. So again, we review that regularly and just keep track of that. Not one exposure is outsized versus another, or some kind of weird allocation that we're not supposed to be. Are there any questions on that particular page? If not, I'll move to slide 4. That might address Daniel's question actually about the sub-asset classes that we invest in within the private equity or private investments. So you see 4 main categories. That's buyout, private credit, venture, and a catch-all opportunistic. If something doesn't quite fit right, we have the opportunity to go there. And these 4, we don't have set sub-targets. We have preferences, but certainly no set policy or targets in that sense. And the preference here is within buyout, since we philosophically align most with the risk return spectrum of that particular asset class. That is an equity asset class. As you recall from our quarterly meetings, that is the biggest portion of the private investments pool. It's about 65%. That is by design, and it will most likely always be the predominant factor in the portfolio. The second largest allocation, private credit. Here we'd like to focus on the senior secured direct lending space. All the rage recently with where interest rates have gone. We have played in this market for over a decade. We found it attractive almost 10 years ago from a, similar to Ethan's comments, probably on a cash flow yield perspective. It just lines up very well with what we're trying to accomplish on the overall pension level. So a more stable cash provider. And then to a lesser extent, we do play in venture capital. You want to keep in mind that we are focused very much on the early stage in VC. So that's where ideas are generated, Uber apps come from. And keep in mind when you read venture capital headlines, primarily in the media, those are usually targeted at the late stage, larger funds, IPO exit markets. That is not necessarily where we look for opportunities. That is a little bit too close to public market movements, and we're trying to avoid that and actually diversify away from that. On the buyout side, one more comment I wanted to make. Again, you hear us talk about the small size or the small end of the spectrum, the lower middle market. We believe there is higher return potential here. Our managers try to focus on operationally improving companies and are less so focused on financial engineering and leverage. Again, headlines primarily are focusing on the large size mega cap funds that we basically intentionally trying to avoid. So our fund sizes are relatively small compared to the headline names that usually get thrown around.
A small asset size would be?
So the funds that we typically look at are about $1 billion or less in fund size. And yeah, I don't want to throw any names on the bus, but when you see headlines in the news, they're usually $20 billion, $30 billion type funds. Are there any more questions? If not, I'll move on to page 5.
Can you tell me
Oh, sorry.
what the mezzanine private credit is?
Pardon?
Mezzanine, private credit.
Oh, within the private credit bucket, so there's 3 distinct strategies, the direct lending, which we're focusing on currently. We do have some mezzanine exposure, so that is playing at a different stage in the capital stack. So that is the crossover between debt and equity. We have had some exposure there. It's not a main focus of ours at this point. The pricing and the returns are not simply not attractive. You can earn higher yields and just direct lending without the equity risk.
Thank you.
On page 5, and you've seen that slide before in other presentations, just the overall view of the asset classes, and we're really primarily focused on the private equity and debt, so that right-hand side of that little box in the middle there. And we do have a very small public equity allocation within private investments in the form of an ETF that could be used as a liquidity tool. It is, John, I don't know what size it is currently, a couple $1 million.
I don't think it's even that
It's
at
not
this
even
point.
that.
We
It's-
had tapped that at one point as markets had moved away from us in public equities and the size of
So it's
privates
just
moved
a,
up.
yeah, it's just a liquidity tool that we could use if we were to get pressed against an upper or lower bound. Okay, to move on to slide 6, I don't see any raised hands. As I hit on a little bit earlier, objectives and the goal of the portfolio. We are the growth engine of the pension, so we were trying to shoot for higher returns and actually be accretive to the overall system. So how do we do that? Primarily, we're looking at a very, very large universe of privately held companies, small companies, think 10, 20, 50 employees. There's over 1 million of those in the US alone. So a very, very large opportunity set for the managers that we work with to invest in these companies and compare and contrast that with, 3,000 or 4,000 publicly traded stocks, so a much, much smaller universe on the public equity side, where returns then become narrower. And in the private space, we just have a larger opportunity set. Our managers have a larger opportunity set and hopefully can produce outsized returns. With that allocation in that universe comes diversification. We're trying to play in a spectrum that is not as impacted from your day-to-day headlines, market movements, interest rates. All these things impact the asset class, but certainly don't move it up and down on a daily basis. Investments here in this asset class obviously come with added risks, which brings me to slide 7. We do face certain risks in this asset class. Up and foremost, illiquidity, the lack of liquidity. As you're well familiar with, these are 10-year, sometimes longer commitments. Capital gets called in, gets invested over very long periods of time, and we cannot simply sell it on a daily basis, but go on the Bloomberg terminal and sell our interest if we feel like it or the market is not in our favor. So that is something, again, that we monitor carefully, manage carefully in conjunction with the CIO, Director of Risk Operations, something very high on the priority list. How do we manage that go forward, and how do we make sure that we have the necessary liquidity in the portfolio? Other risks, obviously, as I mentioned, we're in the private space, so there's very little public information available. i.e., we need to dig deeper on our underwriting and our due diligence process. We can't just go open up, a periodical, some source on Google and research a company. We can't do that, so we have to rely on the managers for us to do that. And in turn, we spend a lot of time, and Ian will hit on our investment process, as I mentioned, in great detail. Spend a lot of work and a lot of time in underwriting these managers in terms of business risks, how do they run their operations, how do they run their organizations, and so forth. And then, of course, more standard, I would call it, portfolio construction risks. What's the sector exposure? What's the geographic exposure? All of these things are monitored on a regular basis across the groups. There are no other questions on the slide. I don't see any. I'll hand it over to Ian to walk you through a little bit more of a detailed portfolio review.
Hi, good afternoon, everybody. I'm the short member of the team.
Coming in at 6'3".
Yeah, exactly. So I'm going to start on slide 8, the portfolio overview. This just outlines the current size of the allocation, $2.4 billion. As Thomas said, just above the midpoint. 17.5% of cap. And right below that, see you later. Right below that, you have the performance numbers. I just make a note on the shorter term performance, the 1 and 5 year. This asset class takes quite a while to mature, so short-term performance is less relevant. But if we look at the 10-year and the since inception number, they're quite good and above our benchmark. Since inception, 13% net. So moving on to slide 9. This shows the composition by strategy. Thomas touched on these. Buyouts the majority, and we believe that we're going to keep it that way just due to the attractive risk-reward nature of the buyout market. Also see 24% in private credit, and then to a lesser extent venture capital, about 11%. And then you see a little sliver there in the opportunistic. These are a couple of legacy insurance-related strategies that are no longer core to the portfolio. But yeah, if we ever encounter anything that doesn't neatly fit into those other buckets, that's probably where we would put that. But again, not a focus at this time. So moving on to slide 10, composition by geography just gives you a breakout of where in the world we're invested. You can clearly see we have a home country bias. Over 80% of the private portfolio is in the United States. No plans to change that. It's the deepest, most developed private market in the world, and tremendous amount of opportunity here. However, we do have 18% international, which is mostly Europe and Asia. And we're selectively looking at opportunities outside the United States, mostly in Europe, in particular the UK. And we'll talk more about a recent push that we made to identify some investments there later on. So if no other questions on geography, moving to slide 11. This just shows the breakout of geography in the United States by state. We're not making any regional bets across the United States. And you can see these kind of make sense. California is the largest, Texas, Virginia, Florida. These are the largest economies within the United States. So nothing too groundbreaking there. So slide 11. So next.
Do you have any, obviously, as Montana potentially in that other states, are there any
Yeah, I'm glad you
investments
asked.
in Montana that we would be aware of?
Yeah, we do have one company in Montana. It's a heavy equipment rental business out of Kalispell, REIC. If you've seen them out there, but
I haven't rented any heavy equipment lately. So.
Maybe you drove by and saw some scissor lifts or something like that. But part of the play there, usually with our managers, they'll buy a platform business and with the goal to expand the footprint. So I don't know the exact amount of states now, but I'm sure they've expanded outside of Montana as well. But headquarters in Kalispell. So we do have one. So. All right, moving to slide 12. This is by sector. You see at the top we have an underweight to utilities and energy. This is in Ethan's portfolio, so not something that Thomas and I are actively pursuing. And then you'll see the overweights in at the bottom there, information technology and consumer discretionary. And so as Thomas mentioned, this is a real growth driver of the pension. And so those are sectors that are higher growth, and that's why you see the overweights there. Yes. Main takeaway here is we're roughly in line with the index. So nothing too crazy there.
What's consumer discretionary? Just retail stuff?
Yeah, so retail would fall under that. So basically anything that's not, a staple like healthcare or food. So it could even be travel or, maybe off-road truck equipment. Just typically things, the overall characteristics is whenever you see a recession, these are the items that the consumer is going to pull back on and not spend a lot of money. So let's see, and no more questions on sector. Move to slide 13. This just shows our exposure to the different vintage years. It takes a manager typically 5 or 6 years to fully invest their fund. So you can see 2018, 2019, those are the largest vintage years we currently have exposure to by NAV in the portfolio. Another point I'll mention here is that we do serially invest across every vintage year. We're not trying to increase or pull back. We don't pretend to know which vintage year is going to perform good or bad per se. We just serially invest across every vintage year. So if there's no more questions on the composition of the portfolio, I'll pass it back to Thomas to talk about the PE fund cash flows and pacing.
Executive director stepped out too, so. Now we
Go
can-
wild if you
Now
want.
we can let loose.
He's already heard it.
He's already heard it, yeah. I want one note on the vintage years, that's, a definition, since we're going through some basics to it. It's really just for us, the interpretation is whenever a manager calls the first capital from us, that year we count as the vintage year. Definitions spray apart there a little bit, but that's how we look at it. I'll touch on the next 10 slides or so, so bear with me. If it gets too boring again, let me know. I'll try to pep it up a little bit. Primarily looking at implementation, pacing, the environment of the portfolio that we're working with. And on slide 14 is a picture of a J-curve. You hear us talk about this all the time. I figured I'll spend a little bit of time on it just to go through it, what is it, what does it do? So in general, think of a hypothetical $50 million commitment, which is typically what we would make to a fund that then gets invested over an investment period, as Ian mentioned, somewhere around 4, 5, 6 years. So those are the green bars in this chart here. That is the money that the manager will call from us, from our capital. So that is a net outflow for us. Then the manager will invest that money in a portfolio company or some sort of investment. Hopefully that will grow over time. There will be some gains, some results coming out of that, and ultimately we will get that money back. The hope is that we get more money back than the manager called from us. That would be in the blue bars, so that is called a distribution that is coming back to the pension system. The net flow of all of that added together ends up in that blue line, which roughly resembles a J, the letter J. And the goal is then at the end of 10 years, our $50 million commitment hopefully turned into $100 million that we get back, which would be a 2 times return. In simplistic theoretical terms, that's how it's supposed to work. Of course, we can't just do that once. As Ian had mentioned, we have to serially commit across years, which brings me to slide 15. Just a colorful picture. Think of every one of these shades essentially as the market value of a commitment year. So in 1 year, we make the commitments to a number of funds. That market value grows over time. As the manager distributes that money, the market value then shrinks and becomes zero at the end of the investment, 10, 15 years. So if we were to just pick out one of these shades, we would end up at zero again after 10 or 15 years. So we have to do that serially every single year. We commit through that in order for us to maintain a certain portfolio level or midpoint or wherever we want to. Again, managing that certainly takes a lot of effort and coordination across several groups here internally. Accounting is integral in managing all these cash flows, for example, for us. Are there any questions on those two
They're my
pictures?
favorite pictures.
Okay,
Picture
good.
tells, are worth 1,000 words. These are awesome.
Trying to add some color. We don't have cool drone videos of properties. Pictures.
Okay, I like the pictures.
Throw in a splash of red in one of those.
All right, we'll do that. I hit on slide 16, the pacing study, and similar to comments that John probably made in the asset allocation study, is a lot more art than science here. Yes, there's a sophisticated model. RBK helps us with that one on a yearly basis. A number of variables go into it. We're making a lot of assumptions, a lot of predictions, inflation, what are interest rates going to do, and so forth. And ultimately, we come up with a range of commitments for us that would hopefully drive us to our midpoint that is dictated by the investment policy. Again, you can see us and hear us talking about ranges all the time because we will never ever hit a specific point target. It's simply impossible. Once the day, I think Becky, you made the comment, right? Once I hit the target, the next day, Dow Jones is going to go 500 points and I'm just, okay, I'm off my target. So hence we're talking on ranges. Outcome of this year's study again was in line roughly with last year. So we're trying to put to work 400 to 500 million in commitments, in new commitments in private investments per year. And we try to do that with about 6 to 10 commitments. So the check sizes will vary a little bit there. So that then results in our historical commitments over the last 5 fiscal years on slide 17. Point I just want to make here, as you can see, it is somewhat consistent. It will range. It is an opportunistic asset class. We cannot predict when a manager comes back to market. We try to, but we can't. But overall, we're fairly smack middle in that range of 400 to 500 over the last 4 years. The note here in fiscal year 18-19, that was based off of a different asset allocation, a different range, a different midpoint. So the pacing for that year actually called for 200 to 300 million, which again, we were right in the middle of that. And move on to slide 18. Again, the historical commitments, it's easier to look back in time and look at the historical stuff rather than predicting the future. This just gives you an overview, the comment I made, how opportunistic this actually is when we start making commitments for the year or planning out commitments for the year. So over the past 5 fiscal years, you see all the different asset classes that we have made commitments to. You heard me say earlier, buyout is the bulk of the portfolio at 65%. So why is it not 65% of my annual pacing? It is simply I keep repeating it, the opportunistic nature of the asset class. Maybe not all of my buyout managers are coming back in the same year. Maybe some variations there. Maybe there's a great opportunity in venture. Last year, we committed a little bit extra to venture capital. We thought it was a good time. So that will move around. And let's just give you a snapshot over the past 5 years of what we've done. Moving on to slide 19. Again, this comes out of the RBK pacing study. This is our historical allocation in light blue, the light blue line. The dotted green line is essentially the midpoint of our range. And you can see how that moves towards it. And of course, we have slightly overshot recently due to some public markets movements last year, not necessarily our fault. In dark blue, that is then the prediction of the model. If we were to commit 400 to 500 million on average, it will bring us to that midpoint over time. One last note on the gray line here I have in there. So that is a hypothetical stop to any new commitments in private equity. Just to highlight how long tenured this asset class is, it would still take us probably 10 plus, maybe even 15 years to manage the current portfolio as it is. So without any new commitments, until it is completely off the books of the pension, it will take us at least 15 years to manage that out. And that is part of the ongoing monitoring process that Ian will hit on in a little bit. Last slide on history lessons for you, sorry. On slide 20, again, for the newer board members, just how does the program, how does it develop over the last 20 years? Again, you see in the dotted lines, a lot of stuff going on this page, but the dotted lines are basically the upper and lower limit of our investment policy for the asset class. You see how that has shifted over time. Next year, or in 2 years, we'll have a similar picture, and then it should stay flat since we didn't have any asset class changes this go around. The dark blue line is the actual allocation of the portfolio, and you see how it moves about within that range. And it might bump up against it. It might cross it at some point. I hope the communication is open enough between us and you as the board that we will certainly make you aware of if and when that ever happens and any potential remedies that we have at that point. But we're trying our best to stay within that range. Are there any questions on that particular page? See none here, none on the Zoom. So I'll move on to the next couple of pages. 2-3 slides are repetitive from our quarterly meetings, so browse through pretty quickly. Page 21, our purchase price multiples, aka a valuation in this asset class. So how much does a manager have to pay for a given portfolio company in terms of its EBITDA? We have, again, in the dotted line, a long-term median average. And just one point that I made in August, I believe, that valuations have come down slightly. We're still slightly above that average. Not a major concern. Just note here that this is highly sector dependent, so some sectors might be well above this 11 times valuation, and others might be much cheaper than that. That we put on the manager to make decisions on where to buy companies. The next page, similar graph, looking at use of debt or leverage in private equity deals. Again, a repeat of our August comments here. For the first time in a long time, we're actually below the long-term average in terms of how much debt is used in a private equity deal. Not surprising, given the interest rate moves that we have seen over the past. The cost of capital has gone up quite significantly for private equity managers. So they're ending up using less leverage on the deals, over-equitizing, doing smaller deals just in order to get those done. One point I wanted to make on this slide, and I believe I mentioned this in August as well. Our portfolio across the board, our managers, our GPs, by design, use significantly less leverage than this headline number that you see on the page here. We tend to be around 2, 3, 4 times levered, maybe on the high end. We're actually underwriting a deal right now. The entry level of leverage is 1.2 in that particular strategy for the past 20 years, I want to say. So plays very well with the target companies of that particular manager in terms of not scaring a family-owned, business founder that we're coming in with 60% leverage or something. So that plays very well in that space. Any questions? I don't see anything. I'll move on to page 23. Just the overall deal activity, how many funds are being raised per year and how many capital is being raised per year in buyout. You see a drop here in 2022. We don't have the calendar year 23 yet complete. So not a concern. I just wanted to bring it to your attention. We do see some variability there. However, we still have over 4,000 funds in private equity being raised each year, and plenty of opportunities for us to find good deals. Makes sense. Any more questions? I will move on to our current thinking rationale. How do we build the portfolio? And Ian has hit it. We continue to focus on the US. It's 82% North American buyout portfolio. It is the deepest market. We understand the law best. We will continue to invest here and look for good opportunities. We will add international exposures as we've done in the past, and we will present maybe a name or two on the December meeting, primarily in the UK. We really like sector specialists, and you can read the whys here yourself, but you don't get your car fixed at the hairdresser. It just makes sense. Private credit will continue to be a focus for us. We take advantage of the current environment and we will play there a little bit. Ongoing, opportunistically, we will evaluate potential secondary market transactions. Not on the high priority list for us at this time. Pricing is not attractive for us. So that would be a situation where we would sell an old fund or a couple of old funds in the secondary market, and an LP would buy that from us. Again, as I said, pricing not attractive, so nothing we're pursuing at this point. And then the one new bullet point on here that I wanted to highlight and just stress the transparency and communication with the board, trying to make very open what we're planning, what we're doing, so you're not surprised a year from now when we're presenting a certain strategy. We are early days on evaluating to implement a strategic co-investment program, and I have a couple more slides on here and I'll explain exactly what that is, what that means. Looking potentially to partner here with an outside provider that will help us implement such a program in order for us to take advantage of the fee savings that come with that investment rationale and deepen our relationships with our managers.
On the secondary market, how liquid is that? I mean,
Not.
It's not very liquid at all.
It's yeah, you basically would have to shop around. It's like, hey, if we have some legacy funds in the portfolio that we don't see moving up or down significantly, we just want to clean up our line items, we would essentially hire an agent who then will shop around in the market. Is there any other LP, somebody like us, a limited partner, who has any interest in buying this portfolio? It usually takes quite some time, months, quarters. It's very costly, and yeah, as I said, current pricing is not in our favor. We would look at selling at very steep discounts, and it just doesn't make sense.
Did you ever buy anything?
We have looked at a buying opportunity, and I should mention we have done a secondary sale, I believe 6 years ago, if I'm not mistaken.
No, I was here. You were here. You were here.
I think we just wrapped it up when I started 5 years ago. So, we could buy in the secondary market, but again, the same discount if I were to sell applies here. I'll buy at a premium. It just doesn't make sense. A couple of notes on slide 25 and 26. So a co-investment, just a little bit education, what is it? Try to create a little graph and a picture. Maggie likes my pictures. So now throw red in next time for Cindy.
A red square? Is that what-
No, just look at the light blue boxes. So we are a limited partner. That's us. We partner with a private equity firm, a manager, or a general partner, and we invest in a private equity fund. So that's the 3 light blue boxes on the top with the little golden arrows in the middle. So that is the general relationship. So every once in a while, there might be a deal or investment for the general partner where they would like to allocate extra capital. That might be too large in terms of their restrictions they have in the fund. They're bumping up against an upper limit on a sector. They can't put enough capital to work. So then that GP would reach out to a select group of LPs like us and ask, hey, would you like to invest some additional dollars with us in this company? We'll show you everything that we do on this particular deal. How do we underwrite it? What's the model? Who do we talk to? What reference calls are we making? And so forth. And you get to place that additional capital at no fee, no management fee, and no carried interest. So that's very attractive. From our perspective, we get more exposure to a manager, a GP that we really like, and bring down the fees, which in turn should increase our returns, theoretically. And the GP, the manager, on the other hand, gets access to more capital cheaper than if he was going to the bank or getting a loan and trying to get that money. So kind of took away the key takeaways on page 26 already. That is the primary goal for us would be to bring down fees. So we're looking to build a program that would ultimately invest in our current high conviction general partners at no fee, no carry, and to take advantage of that fee savings and in turn increase our overall return profile. There are no questions on that. Open for discussion. Jack seems satisfied.
I think you're doing a great job.
All right, then I will pass it on to Ian to close us out with the investment process. Again, just a goal here to get the board members, primarily the newer folks on the team, really comfortable with what are we doing, how are we doing it, how much work goes into it. And yeah, please ask questions as we go along. I have a couple of things that we're going to try to share on the screen. Nothing, no drone videos yet. Something. All right.
Okay, great. Thanks, Thomas. Yeah, so to close us out here, we'll go through the investment process. So how do we source a deal? And then what steps need to happen for that to become a line item in the portfolio? We have a prescribed process that we follow every time. And we thought that rather than just reading off slides, we could kind of just walk you step by step through a recent market map we kind of made of the UK earlier this year, and then to an investment that we recently closed. But before we get there, just looking at this summary chart, I'm on slide 27. We got deal sourcing is the first step, screening and due diligence, a cabinet meeting where we approve the investment. Once that's approved, we go to a legal review. And then after that, legal is closed out and we're officially invested. How do we monitor that investment? So starting on the first point, the deal sourcing, this is our snapshot here of our research management system called Backstop. So every call we have, every Zoom, every in-person meeting, email, everything we track in this system. And this here is a dashboard that we work out of. And so as of the end of the fiscal year alone, which keep in mind June 30, so just a few months ago, we've reviewed over 120 deals. And you see here on the funnel on the far left, it's kind of small, but that funnel there is 95 funds that we've passed on. So then Thomas, if you just scroll down one.
Working on it.
To the next one, as you work your way down the funnel, eventually, so we kind of skip some stages. There's funds that we track. Once we go into an official diligence, we switch them to a diligence phase. Then once they're approved at cabinet meeting, then they go into legal. Once they pass that, they move to invested. So takeaway here, bottom of the funnel, we have one deal that was officially closed since the end of the fiscal year that we'll present at the next board meeting. Main takeaways, we review hundreds of deals, less than 1% will ever make it into the portfolio. So yeah, go ahead, Megan.
What's the role of legal?
So legal, we're
Contracts?
reviewing the limited partnership agreement. So we invest in partnerships.
That's outside
That's
counsel.
not, yeah, I just wanted to make sure that I was on the same page.
Exactly. We have an outsourced counsel that we send all the docs to, and we got a couple of slides on that too. So we'll touch upon that. Okay. So that's the first step of the process. So back to my UK example, we identified the UK as a good way to invest internationally in an attractive market, similar to the US PE market. So how do we know who to talk to? So that deal sourcing process starts here. So I'm on slide 28. You have a list here of the contacts in our network. We call placement agents, who are essentially brokers that will represent multiple funds at the same time. Placement agents, we talk to LPs who we're friendly with, especially our European LPs, since it's their backyard. We've talked to some of our current GPs that know Europe well, and we did some searches within our data providers like Preqin and PitchBooks. And this returned to us a list of over 15 funds who we are interested in having calls with. And so what you have here is a slightly redacted version of a report we pulled out of Backstop, because over Q1, we did 16 Zoom calls with managers in the UK. And you can see here, these are how we track that. So we would get off the call and we'd write up notes. What did we like? What things concerned us about the strategy? Basic summary of what they do, their track record, who owns it, fund size, and then fundraising timeline. And these are redacted, and we're just showing snapshots. If you want to see full reports on anything we're about to show, we can show you everything offline. I'm happy to do so. So basically, after all of those calls, we could sit down, we could look at 16 of these, and then realize, okay, who do we need to get in front of and have in-person meetings? And so that takes us to slide 29. How do we screen all of that and enter into due diligence? So out of all those Zooms, we identified 7 as being interesting candidates. So John and I actually went out to London in March, and over several days, we ran around and met with all these people in their offices, had a couple of extremely packed days. And one of these managers was a definite standout that we were really excited about. So the next step in the process outlined on slide 29 is the DDQ Part A. DDQ is the due diligence questionnaire. So this is a 6-page document that asks general information about the fund, strategy, and the organization. And Thomas has it here up on the screen. And this allows the manager to describe their fund strategy. And the purpose of this is to put a lot of the deal killers in it. Like one of the questions is, are you currently under investigation for fraud? Some really high priority items that would immediately make us stop doing work on that opportunity. So the Part A is a good way to really screen out folks. But again, we don't just shoot this off to people that we haven't had conversations with. This is a couple steps down the process. So after sending this UK standout fund that we're going to present in December, after we sent that DDQ Part A to them and they returned it, they came out to Helena to visit with us, and they spent the morning here meeting with all of us. We felt like that meeting went really well, so we sent them the rest of our due diligence questionnaire. I believe it has 17 sections. We just have the 1 through 3 up on the screen. And this will usually take a manager about a month to fill out and get back to us. It's extremely comprehensive. We ask about their history, operations, accounting procedures. It's extremely in-depth. And when they send it back to us, it's usually over 100 pages long. and takes Thomas and I a few days to read through it.
Do you ever have any prospect that says, no way? Do they look at your questionnaire and say, okay, maybe not?
Yeah, you know, it's pretty rare for us to do that. I think the commitment size that we write. So a lot of funds, they fill out a standard ILPA. ILPA is the International Limited Partners Association. This is what 80% of ours is based on theirs. And a lot of them will fill out that and they'll just say, hey, we've already filled that out. You can go look at this. We don't invest in funds that would do that. The partners that we work with are happy to fill out our version because we do have some Montana specific questions in there. So yeah, if someone refused to send that out, we'd probably stop the process for us. But yeah, good question. So while they were filling that out, you know, we had a lot to do on our end as well. We scheduled 16 reference calls with past CEOs that these folks had worked with, some of their past employees, other limited partners in our network who were familiar with them. And we did 16 of those, talked to some of their bankers, some of their service providers, just really trying to get a good feel for their reputation out in the market and their competence levels as well. And so those went really well. We also performed background checks on all the key personnel of the firm during this time.
Do they have to sign something?
No, we use a third-party background check organization who's able to scour a lot of publicly available information, and it's pretty comprehensive. It's pretty surprising what you can scour off the internet in different, you know, legal databases without asking their permission. There is a version that we could pay more for where they would need to ask for permission, and that's more like their personal credit reports and stuff like that that we don't get access to, but what we get is pretty comprehensive. And they know that we're doing it.
We tell them that we're doing
You tell them you're doing it, but.
Yeah, they know.
it. They know.
Yeah, and
Because you
nobody,
get different kinds of things when you're doing it just through somebody searching out in the public domain versus somebody actually going out and look at records, arrest records and.
Well, you can, I
You
mean,
can see all the public, you can see all the arrest records and all
Yeah.
of those sorts of things. All of that is public essentially. So
Why do employers pay to have background checks done on their employees?
because you have to pay this company to do that.
we pay.
Oh, you are paying,
We have to
okay.
pay more to have their permission and get, you know, deeper data, yeah. So, yeah, it's pretty expensive. But, you know, when you look at the amount of dollars to work,
I
it's
agree.
well worth it. Luckily, most of our background checks come back completely clean, which, you know, says, you know, we're talking to reputable folks in the first place.
Should we
So,
poll dance?
You grew up in a concert.
Nothing's on record there, John.
Yeah, I think there was a fire at the courthouse or something.
Started.
Okay, so then, after all of that, they sent back the DDQ Part B in its entirety. They did a great job filling it out. We were satisfied and getting pretty close to saying yes to a commitment. At that point, Thomas and I planned an on-site meeting back in London with the team. We do this every time we're meeting with a new manager that we're getting to know. We need to be in their offices, meeting with their people. We do a tour of the offices, so, you know, no boiler rooms. We, you know, make sure there's servers in the server room and there's, you know, people are sitting in
No
desks.
bars on the windows or?
Yeah, exactly.
No bars.
No Ferraris in the parking lot. We go get a real feel for, you know, who the firm are and how they operate. So Thomas and I went back to the UK and met with them in their offices for about 6 hours. We interviewed every employee at the firm. We asked questions, anything that, when we're reading through the DDQ, it's the due diligence questionnaire, we write down everything that we might have questions about. And then at the onsite, it's a great way just to face-to-face go through that list. And if anything popped up on a background check, we would address it personally with them. And depending on how sensitive it is, we would, you know, either do it alone or as a group. But in this case, we didn't have any background check follow-ups. So after that on-site, we were very comfortable with the team, the organization, the strategy. They worked really well with us through the whole process. So the next step after that is taking that 5 months of due diligence work and building out a fund profile in-house that has all that information, organization, strategy, team, history, performance, and then that is circulated to the cabinet members. So that's moving on to the next step, cabinet meeting on slide 30. So those fund profiles for that investment are circulated to everyone who attends the cabinet. So the asset class directors, director of risk operations, and the CIO and executive director. We then meet and go over the opportunity. Thomas and I present it, answer any questions that pop up, have a robust conversation about the risks, the rewards. Does it fit within our IPS and risk parameters, and just kind of the overall strategy. And if everything checks out there, and the CIO with conjunction with Dan, if they give the sign off there, we will alert the manager that we are going to move forward with the investment, and that moves everything into the legal phase. So then in the backstop system, we would move this forward down the funnel to legal.
So how often do you get to this stage where somebody's rejected?
So for us to go to cabinet and to get rejected, I'd say would be unusual because we involve senior members in the process. So John was with us on the first trip to March and met them. Dan went with us the second time and was involved in that diligence process, and just all the different hallway conversations we have. If Thomas and I knew that there wasn't support for an investment, we wouldn't bring it to cabinet. I don't know if you want to add anything there, John.
Would agree with everything you said. It's rare. It's happened probably, if you think of probably 2 instances since I've been CIO where I've said no pretty late in this process. So it's not frequent, but it has happened.
It's a pretty deep dive up to that point.
And I guess the other piece of that would be.
It's a lot of work.
And Ian's exactly right. We're talking about this a lot. So we've already, particularly Thomas and Ian and me, we're talking about it a great deal. The other piece where maybe it could fall apart, I'm trying to think of an instance, is when it hits legal and there is some terms or things that they won't budge on that we feel like we need. And that's pretty rare because by that point, they're pretty invested, we're pretty invested. So likely we're going to come to some compromise on those things, but it could happen.
Yeah, exactly. Okay, so the legal process, so after that meeting, we will send all of the documents related to that investment to our outsourced counsel, who will do a deep review of the partnership agreement, the private placement memorandum, and any other documents that they provide us. And they return, it usually takes them a couple weeks because they send us back a full summary of all the legal terms of the fund. And if anything is off market or unfavorable to us, they'll have recommendations in line with those notes that say, hey, this is off market, or we would recommend requesting this or pushing back on this term. Thomas and I will review that and then send that back to the manager and just kind of get a conversation going back and forth. It's a negotiation. We don't win every battle. We do have some really high priority items that we would walk away from, but we would have known about them before here. A lot of our deal killer legal items are in that due diligence questionnaire. So typically we're usually not too surprised when we get those legal terms back. But however, we work with good partners and GPs, and it's usually a compromise at the end of the day.
Who's our outside ones? Do we have more than one, or?
Yeah, we do. We use DLA out of Austin for the majority of our funds. However, if there's a conflict, we do have a backup. Jackson Walker, in case there's a conflict, maybe they're already working with that GP on something and they can't represent us. But DLAs, we think very highly of them, and they're kind of known in the market as being the outsourced counsel for LPs. So we like that about them. And they come out here and we have, diligence sessions where we, can talk and share notes and stuff. So they've been a great partner. As John mentioned, in the past, we have walked away from deals that we can't get comfortable with on the partnership on the partnership agreement. So if there's no more questions about legal, I'll move on to slide 32. So this is fund monitoring. So this is the last step of that investment process. So once we're officially invested in the fund and we sign the partnership agreement, send back the subscription documents, we will set this investment up with our custodian, State Street. So we are able to wire the money for our capital calls. They know where to send the distributions back to us. We receive quarterly, annual reports and financials to stay current with the general partner and get a status updates on what they're buying and their investments. We have periodic calls with them. Usually funds will have annual general meetings that we try to attend in person if we can. If not, we can do it by Zoom. In most cases, we get a seat on the fund's LPAC, which is the LP Advisory Committee. Basically being on the board of a business. We get to a little more access to the GP. They'll have separate calls just for the LPAC members where they'll go into a little more depth in what they're purchasing and how the portfolio is developing. And then we'll often be asked to vote on certain issues. Usually conflict of interest as they arise, but there's other things like if they want to extend the fund by a year, or there's a whole list of things in the partnership agreement that the LPAC members would approve or deny. So yeah, the last point I have on this slide is just to kind of reiterate, we do this every fund, every time. You know, we don't skip steps. You know, maybe we have a really great meeting and are really excited about something and we think, oh, we'll just skip this section of the process. We don't ever do that. Here's the prescribed process. We do it every time, and that's just to ensure we avoid pitfalls and are making the best investments for the pension. So that's kind of all I got. Thanks for listening. Happy to, both of us were available to answer any questions.
Say a general partner that you've used in the past, say you've done Fund 1, Fund 2, Fund 3 is coming up. Can you describe how the process is different or not different for Fund 3?
Yeah, absolutely.
And same strategy, assuming same strategy among all three.
Yeah, absolutely. So in that case, we wouldn't be required to do an actual physical onsite with that manager. Unless like some significant changes in the org happened, that would give us cause to want to be on site and kind of like refresh it. And we have done that before, or maybe we missed a fund, for example, but in your question, that wasn't your question. We might not do as many background checks, or we might do background checks on newer people. Maybe some new folks entered the partnership or the investment team. We might do background checks on them, especially if we have no reason to do background checks on some of the other partners that we might have just done 2 or 3 years prior. Other than that, excuse me?
Fund size?
Well, if the fund size got too large, that might be one reason why we wouldn't re-up with that manager. But as far as the process goes, it would be very similar. We would still send them the due diligence questionnaire. They would still have to send us their complete track record, every deal they've ever worked on, what the results are. So other than the on-sites and maybe the background checks, I would say the process is identical.
Okay, thank you.
Yeah, you're welcome.
How do you, obviously you have a large process here. How do you monitor that the process is producing, the fund selection that you would expect? Is it forward-looking monitoring, or is it backwards looking at the ones that you screened out and didn't select, or how do you guys do that?
Yeah, as far as, anything, Thomas, you got something here?
I jump in there. So the overall process and how it, the return or the outcomes that it's producing, has to be backward looking, right? We can't predict potential outcomes. What this process encompasses is really the primary focus around is the relationship with the manager. How are we being treated and all these things that we request? Is that going smoothly? Is that going according to plan? And over time, so Becky's example, if we then were to come to a re-up opportunity with the same team, the same fund, the next fund, we would then look back as like, hey, how have they treated us the last time go around? How was the legal negotiations? How's the track record developed? So all of these things flow into this, and how we monitor it is essentially what we saw on the screen, that backstop system. So every interaction is logged in there, every little note. Even if I run into a general partner down the street in New York, I will log that in there, say, hey, I ran across XYZ, we talked about this and this and that. And then we can go back and look at that when it comes time for the next fund to review. And then obviously
Did that answer your question?
Yeah, so well, I guess maybe that as part of it, maybe it's not so much that the process is designed to produce outperformance among other, other opportunities. It's more, I guess that's what I was looking at.
Yeah, and we have kind of on the agenda to kind of think where you're getting at is doing more work on maybe commitments we've already made and maybe picking the lower performing ones and seeing maybe if we missed something. Is that kind of?
Yeah, kind of that would be.
Yeah, so it's like a study that we're currently working on too, just to be better investors ourselves. But yeah, this process, a lot of it is around, the organization set up in an institutional way. Do they have the current procedures in place? We'll ask them, how many signatures are required to wire money? These types of things that are going to really avoid fraud, for example. And we won't invest into a fund unless we have some type of tangible realized track record. So these groups have to show, we have performed in the past doing the similar deals that we're proposing to do in this fund. So that's on the performance side more of how we would, kind of pre-vet a team. If someone showed up and said, hey, I was maybe someone more junior at another firm and I'm going out on my own, that would be something that, Thomas and I, we might have a conversation and say, hey, let us, maybe in 5 years after you kind of develop a track record, there might be something to do here, but right now it's just too early for an institution like us.
And isn't
If I understood part of the trustee's question, it was, how do you know that you've passed over funds that would have been even better? And there are two ways, albeit with a substantial time lag. One is you can find out where in the quartile of successfully raised and invested funds, the fund that you actually invested in ends up landing with respect to its return. And so that's one way to do it. And another way to do it is to look at your private equity program in terms of IRR or time-weighted returns over a longer period of time and compare it to peers. So, there are ways to do that, but because things take time in this asset class, you don't know them right up front. So I'll stop there. I think that was correct.
Yeah, thank you.
And you also have other data sources like Preqin or others in the market where you can look at funds that you passed on to see how they did, or groups. If you passed on a fund or a GP in the past, their returns of those funds are published in databases. So that's really a nice way to keep track of folks that you considered but perhaps didn't make the final cut.
I think that's all right, but I think one thing you have to be careful of in this universe as well, and Thomas mentioned it earlier, is sometimes we may be perfectly happy with a manager who achieved, let's say, a 2.5x return, and maybe the top quartile is 3 or something, but that's because they were in an environment where they were really highly leveraged.
Yes.
And so if we don't keep up with some of those types of strategies, we're okay with that. So there is somewhat of a risk return dynamic within the space. If you will remember perhaps from some of the other presentations I think we've done in the past, this is an asset class where the dispersion of returns among managers is the widest of any asset class, right? So there's managers that are, absolutely terrible that are returning a 0, and then managers that are just knocking it out of the park. But a lot of what these guys are doing is really unearthing how are they achieving those returns. And even if they were a top quartile, top decile manager, if they did it all through financial leverage, that's probably not a fit for something that we want. So, they're good information points and we'll look at all of that, but the context of kind of what they're saying is, how do we know how this manager makes their money and who do we want to be invested in is pretty important here.
Well, John, that risk return trade-off that you just talked about also applies in other asset classes. I know you've followed the same general preference with respect to high yield, for example.
Yeah, similarly. The other thing I maybe would note for board members is Backstop, the tool that they kind of briefly showed you. We implemented that, 9 months ago?
9 months ago?
Yeah, so it's a relatively new, and I think it's been really, really good for helping us keep track of all these things and sort of getting all of that institutional knowledge within one place, maybe similar to our prior conversations earlier today.
Just one last note, sorry, didn't address the question directly enough. The process itself is more qualitative, excuse me. So it's harder to judge past investments, right? And the one note I wanted to make, we do go through an annual conviction review with the CIO of the entire portfolio. We go literally, like you see in the appendix, line item by line item, and we talk through, okay, how has this fund performed? Why is it underperforming? Why is it overperforming? And so forth. And then that then flows back into our investment process. Okay, when it comes to re-up with this manager, are we going to do that, or are we just going to pass straight up? Okay.
So you do look at that, I mean, because I'm looking at some of these negatives.
Correct, yes.
There's one that's got a couple negatives, big ones that I can see. And I'm thinking, sure hope you ask good questions if they want you to invest more. I mean.
Yeah, we can't avoid losses, right? We're trying to minimize them. And I think if you go through this list, there's 4 line items in there that are currently negative. Those are fairly old investments. There was not really, when we go through the process, there's not really any mistakes that were made per se. A lot of those were firms got into trouble, human behavior got the best of a general partner. It's, we're trying to minimize these for sure.
6 of them, just see.
Six of them, okay, thank you. But again, out of
one big one.
Out of 125.
Yeah, one pretty big one, but it's relatively new.
The new
So
one
that
does
could-
most likely the Ascendant Fund down, you're referencing 2019,
I think there's 4.
2021, this one.
2021.
Yeah,
So that, you can
Well,
speak to that.
there's 4 realized losses in there, and then the 2 recent ones are funds that are still developing. So on that J curve slide where you saw, so cash flows are going out.
So that's what I was
management fees, yeah. So it's
There's some really old, I mean, there's 2 really old ones, 12 and, 12 and 14.
Yeah, those funds are likely to end negative, whereas the 2 earlier ones, we don't expect them
Yeah.
to stay that way. Yeah.
That's good to hear.
The particular one you're calling out, the one is big number, yeah, that is clearly in the J curve. as
The
was
heart just
described.
went pop when I saw it, and then I thought, oh gosh, it's only
Not to panic
2021.
there. It is
So we're at that
early
part of it,
days. Yeah, we haven't seen the full potential out of that one.
Basically, to get the returns you're getting, you have to take some risk. And there's gonna be some losses in there, but you're just trying to minimize that. You're trying to stay more to the middle and not to the extremes of the thing.
Exactly.
Well summarized, thank you.
But is it correct that, there's a lot of names here, but we're trying to trend towards more commitments to bigger commitments to ones we really like?
Maybe on the onset, could have mentioned that we are actively trying to lower that overall number of exposures that we have in the portfolio, simply from a management perspective. It just becomes easier. So that's why you see us talking about re-ups at the quarterly meetings. So we find a team that we really like, and then we will most likely commit to 3, 4, 5 funds in a row. So the overall line item on this page will be the same, but the relationship is minimized at that point because it's just one.
Any questions? If not, thank you. Good job.
Good, thank you.
Thank you. Thanks for listening.
And we better get a good presentation on that United Kingdom travel too.
Please feel free to ask Dan, he was with us on the trip, so.
That's what I'm afraid of.
It's
6 hour
very
diligence session.
expensive over there.
Oh, yeah.
How long did you stay outside of business?
I did 3 days.
Hardly enough to get over the jet lag. You're much younger than I am.
Thank you. No, but thank you.
True. Not as easy as it used to be. Your day will come.
Okay, let's move on. So we've got a recap of stuff for staff for Dan to do. I didn't have anything, do you?
We don't, we'll work on the letter. We'll have the asset allocation affirmation in December. TRS and PERS will be here for their annual report to us. I'm doing my annual report to PERS in December and TRS in February. I think that is, other than regular annual December is sort of our affirmation meeting. Here's our resolution or policy 217, approved managers, that sort of stuff. So unless I have a lot of other things come up, may need to call for a special meeting of the loan committee, depending on how the housing front goes. But otherwise, I'll see most of you in 2 weeks from
Boise.
last Monday in Boise for our training, and everyone else in December.
Okay. Anything else from the board?
Dan, is there transportation back to the airport after all that?
You will Uber and they'll reimburse you for it.
Okay.
Okay,
All right.
nothing else? Meeting adjourned. Thank you.